My father risked everything and bought a railroad out of bankruptcy and created a really incredible legacy for myself and for everyone coming through. But he kept all his cash and he has his world. I have my world. So I built mine through 25 years of commercial real estate and finance. Where we are today, what we look for, we're in about 14 different investments that are commercial real estate focused. In the financial world, we're in alternative investments for a hedge fund, and we have a public ETF that we invested in at the incubator side of it, now 80 million asset, which is great. We own part of a bank. I look for private credit funds out in the marketplace, but I'm always nervous because they may not have the balance sheet to withstand foreclosures and issues that come through. I can't tell you how many private credit funds I get to see and look at and said, so when did you start? Oh, about 3 years ago. I'm like, oh, great. Have you ever been through 2008? Have you ever been through, 1991? Have you been through all the different downturns? Do you have to withstand and look at it, right? In the technology space, we look for some things that are, a bit built like a moat as protection. I get nervous with AI because I feel like it could be changed every 6 months, every 3 months, if you will, because another tech company come in, or what DeepSea came through and blew out some of the AI stuff that's happening. But I like technology focus with AI as a part of it, but it's not the main focus. In some of the other ventures and things we've gone in, my core ones that I'm spending a lot of time with, which is a bit annoying because I went in direct to ownership. I started as a limited, then I went up to the cap table to take over control because a lot of young entrepreneurs kind of lose sight of what happens as they mature in their company, or a couple black swan issues that happen, right? We all know what happened in April of 22 and May of 22 when rates started to scream. A lot of people didn't pay attention to what was happening, including me and some of my real estate. When we invest, I try to be Marcus Lemonis and create my own venture fund, if you will, where I'm people, process, product. I try to figure out if the people understand their experiences, their core competencies, what they're doing. Very eloquent. He's a great operator, by the way. He, as a very young age, he had to take over, become an operator. These are the guys that I would invest in because he comes from the operating world and understands what it's like to hire people, to fire people, to increase revenues, to cut costs, to have to deal with governmental issues, things of nature. You want that experience in that people side. The process side, everyone's trying to figure it out, especially when it's a new product, and if they're continually learning and continually increasing their appetite for efficiencies in their process, those are the type of people I look for. Mistakes that I've made are 1,000 times over. Yes, venture does suck and real estate sucks, and so does tech, and there's a lot of issues that are going out in the market. What I've missed is understanding market fundamentals and market issues that some of my businesses in the consumer product side or the real estate side got really hit by the interest rate increase. And I didn't pay attention how much that could affect in my portfolio, what it looks like. And so being a little bit more diversified and paying attention to if the rates really did scream like it did, what is my counterbalance to that? And quite frankly, we hadn't had an interest rate run in 40 years of that nature, right? And I missed it. And that's one of the things I'm annoyed with, and it's like running with a parachute. I've got some businesses that are kind of caught and trapped because the interest rates have been where they are, and it's now, according to our illustrious Mr. Powell, that it's higher for longer, right? And so that's a problem. So how do we figure that out? How do I reduce my exposure to those interest rate driven type businesses? As you know, in a high interest rate market, insurance does well, lending does well, and companies with big balance sheets that have liquidity do well. So my next investments are paying attention to cash flow companies that have gone through a bit of the mess in the last 5 years, and they're now on a next paradigm shift where they just need an extra $1 million or $2 million to go in. Our family office has created an entire capital raising arm, of which I'm tied to New York, and we're on a broker-dealer platform where we can raise capital for all our ventures come through, because that's what's new to me is our due diligence process now has to be understanding capital raising and how we're going to be a part of it, because I can't always be writing the checks into it. We need to be able to co-invest and bring in other families in, as well as other ways of how capital is raised through RIA model, the broker-dealer model, things of that nature. So hence why I have an investment bank with me.
Thank you. I really like how you broke that down and also gave us some real life examples on how you're implementing that into your own family office. And I think Richard mentioned it earlier. You know, we had a speaker on stage at one of our last events, and he mentioned that people opportunities, people problems, right?
If you are a founder, raising capital, developing real estate, or you're an investor, would love for you to get involved in the Family Office Club. I've run this community for 18 years now. We've hosted 300 live events. We have 17 million social media group members and followers. We have the #1 YouTube channel on family offices. We have the #1 most popular podcast on family offices. You can learn more about us and our membership options at familyoffices.com. We have 30 in-person events planned in 2026 and another dozen events this year. Please go to familyoffices.com to learn more.